Welcome back, everybody, to VTS Options. So some of the trade types that we use in the options world follow a more standardized structure, and there's very little deviation from the norm. Iron condors, for example, definitely one of my favorite trade types, but it's very rare that we do anything but the standard at-the-money short iron condor. They all look pretty much the same. But the trade I'm going to go over today is much more diverse, and there's many different variations depending on both market conditions as well as the trader's goals, and it's called a butterfly. What makes this trade interesting is that they can be done with both puts and calls. They can be delta neutral at the money or directionally more out of the money, and we can also shift the risk around a little bit by doing what's called broken wing butterflies. They are very diverse. So please subscribe to the channel down below if you haven't done that already. Smash that like button for me, it really does help the YouTube algorithm, and let's get into this trade that I really think you're going to like. So the standard butterfly option spread is constructed by selling 2 times the short option of the same strike price in the middle, and then buying 1 times long options on both sides of that. And of course that can be scaled upwards by just maintaining that 2-1-1 ratio. But your trading software will make it very easy. You can do all of this in a single transaction. And when we do this, here's what that trade looks like. Now remember, we can trade these using either puts or calls, and that will depend on the situation. If we're trading at the money, meaning today's price is centered very close to the middle of our trade, then it really doesn't matter which one you choose. For me, I always default to the put butterfly if it's at the money, but you could do calls as well. But if you're using these trades directionally, then you'll want to use the puts for butterflies that are centered below the current price, and calls for the butterflies that are centered above the current price. This just allows you to keep the short strike of the trade further out of the money. Now the risk profile here is for the standard at-the-money butterfly. Here on the horizontal axis we have the price, and then on the vertical axis the profit. Now right away, one of the big benefits to this trade is, because we're buying both of the wings on the outside, that means the maximum loss is capped at the total premium paid. We know exactly how much we can potentially lose right from the outset, so managing risk is much easier to define. And the maximum gain for the same reason is also known in advance. So limited gain and limited loss defined at the outset of the trade. Now if you're a little more experienced in your options knowledge, you may have noticed that this trade is actually very similar to a short iron condor. The only difference between them is the shape of the gain portion of the trade in that middle section. Short iron condors spread out the potential gain evenly between the entire range, and butterflies go from 0 to a much higher peak potential profit in the middle. Choosing between these just depends on market conditions and your goal for the trade. And then lastly, that curved pink line is the daily profit curve, which is important, and I'll go over that more in my trade example shortly. But first, let's quickly talk about the Greeks. The Greeks are statistical values that provide us a way to measure the sensitivity of an option's value with respect to other factors. We have price, time, and volatility. Now, because the butterfly is a very diverse trade, the Greeks will change a little bit depending on what type is being used. This here is showing the standard at-the-money butterfly. Delta is an option sensitivity to price. At-the-money butterflies are delta neutral, also known as market neutral, and the trade profits from a lack of price movement in the underlying. So we are indifferent to direction, up or down is fine, as long as it doesn't move too far in either direction, so it's delta neutral. Theta is an option sensitivity to time. Butterflies are theta positive, meaning the position gains value with the passage of time. Every day that goes by, the contract does decay a little bit, and butterflies benefit from that positive theta. And lastly, Vega is an option sensitivity to volatility. Butterflies are Vega negative, meaning they benefit from decreases in volatility. So now let's go over a trade example to reinforce some of these points. So this is the Thinkorswim platform from TD Ameritrade. Now your software might look a little bit different, but all platforms these days should be able to handle any advanced option spread, so these butterflies are going to be just fine in whatever platform you use. Now the ticker we're looking at here is TLT, this is 20-year US Treasuries. And remember, with the butterfly trade, we are looking for an underlying that isn't expected to move around very much. It profits from the price remaining pretty stable. Now in the past 1 year, this doesn't look very stable at all. But that is because there's been a lot of action with interest rates. You can see this chart here, this is the federal funds rate since 2000. This is 2009 right here, the financial crisis, where it was pretty much flat for about 6 years. And then the Fed did start raising interest rates. There were actually 9 rate hikes. But all of these red numbers, this is the past 1 year. And they've basically unwound all of the progress they made, and we're back to about the zero barrier. That's why there's been so much movement in TLT. But now that we are back to zero rates, the trade thesis here is that essentially over the next few months, rates should remain fairly stable. If they turn around and do a rate hike right away, that would probably be a very bad sign for the economy. And likewise, if they further cut rates and we actually went negative, again, I think that would send a bad signal. So we're probably in store for some stability over the next several months, which is fine for this trade. So we'll go over to the Analyze tab. This is the option string here. We've got a bunch of choices here. Now, I always stick to the monthlies. Those are in white. And I do want to give this trade a little bit of time to develop. So this July contract for 56 days to expiration, that's going to be just fine. With TLT trading at 164.56 right now, we're just going to go down close to the money here. I always default to the put side, so that's over here. And we're just going to buy a 165 butterfly. So your software will be quite similar. You'll be able to select from a list here. Like I said, we can do this in a single transaction. We can just click butterfly, and it creates the trade for us down here. Now again, just a reminder, you can see we are selling 2 contracts right at the money at that 165 put. And then we are buying contracts on either side of that. And when we do that, it creates the put butterfly. This is the familiar shape right here. Now, of course, this is far too narrow, so we'll go down here and we'll adjust this a little bit. I'll go up to 175 on the high side, and then down to 155 on the low side, so it's even on both sides. And now this looks like a pretty good trade right here. We've got break-even points at about 159 on the low side, and 171 on the high side. So a pretty decent range in the middle, and this is where we want the price to hang out. So remember, because we are buying long options on both sides of the short strike, that does mean that the maximum loss is capped. And we can calculate that very easily. It's just the premium that we're paying, in this case $3.90, multiplied by 100. So you can see if the TLT does go down really low, $390 per contract is the maximum loss. And on the high side, it's the same thing. $390 on either side of this trade is the most we can lose. Now, the advantage to the butterfly spread that the Iron Condor doesn't have is that the maximum profit does reach a pretty high peak here. So if we're fortunate and there's very little movement throughout the next month or so, we can actually make a fairly substantial profit. Remember, Iron Condors will be consistent through the whole profit range. Both trades are fine, I use them a lot, but it just depends on your goals, and I think TLT will be fairly stable, so I'm going to go with the butterfly in this case. Now we can check the Greeks and just see how they line up. First of all, delta. You can see it's slightly positive. The market's bouncing around a little bit right now, but it's basically a delta neutral trade. We don't really care if it goes up or down. As long as it hangs out in this center range, we're going to be fine. The next Greek is theta, and this is a theta positive trade. You can see right there, positive $1.58. Now that doesn't seem like much, of course, but this is a daily value and it does rise exponentially as we approach expiration. So it starts at 157 right now, but that will increase with every passing day, so it does add up over time. And lastly, again, because we are shorting 2 center strikes here, this does make this a Vega negative trade. This means the trade will profit from a decrease in volatility as these short strikes diminish. Now, I mentioned the daily profit curve, and this is very important because I don't let my trades go to expiration. Whenever I'm trading delta neutral strategies like Iron Condors, calendars, butterflies, I will use both a stop loss and a stop gain because I don't want them to approach expiration. One thing I like to do as soon as I open the trades, I just calculate what the stop loss is right from the start. So if I use a 50% stop loss, that is based on the premium paid. So 50% of $3.90 is going to be $1.95. Multiply that by 100, and the maximum loss per contract that I'm going to allow this trade to suffer is $195. So you can see as we go down this daily profit curve, that pink line, we can actually just go ahead and find 195 and put the hash line right there. And then we can do the same on the high side. If it's going up and TLT happens to continue higher, then we will hit the stop loss at about $195 right here. And we can move this one right to today's price, and we can see where our losses are going to happen. Every day, we can just check out where the price is, see where our gain or loss is, and we can let this trade go for a while. Now, on the gain side, it's very easy as well. This pink line, hopefully, if the trade goes well, will just continue to rise. And as soon as we hit $195, that's going to be the stop gain, and we're going to go ahead and take the profit off the table and just move this capital into a fresh new trade. If it's 50-50, then all my job is to seek out trades that will have more wins than losses. And in the long run, that does add up to a profitable system. So we can see the trade again in the chart here. We are just looking for TLT to go flat. Now, I wouldn't have opened it back here because interest rates are bouncing all over the place. But like I said, now seems like a pretty good time where the risk reward is probably worth it. Now this second hash line here, that's the July strike. We're not going to let it go anywhere close to that. Because we're using stops, it's probably going to be about this range. So we can just highlight we're looking for something about in this range here. If TLT just chops around and passes through this range, we should hit our stop gain and the trade will be successful. Now, I will do a couple of follow-up videos in the future talking about ways that butterflies can be used more directionally out of the money, as well as those broken wing butterflies that I mentioned, so stay tuned for those. But let's review that standard trade. They are delta neutral, they are market neutral trades, and as long as the price doesn't deviate too far from the middle, then they can capture that profit. They're theta positive, which means that with each passing day, as long as the price doesn't deviate too far from the middle, we will be collecting profit each and every day that goes by. And due to that double allocation of the short strike in the middle, these are vega negative trades, which means they do profit if volatility declines. These are very good trades to open when volatility is a little bit elevated. And also, because of those long strikes that we buy on both sides of the trade, these are both limited gain and limited loss trades, which makes risk management very easy. We know right from the outset what our maximum gain and our maximum loss is, so position sizing is pretty straightforward. If you're a member of the VTS community, you'll already know that I use these butterfly option spreads within my advanced strategy that I call directional flies. If you're not and you do want to see how that strategy works, as well as many of our other ones, go ahead and claim your free trial on my website, and you can check out some of our live trades. You're always welcome to join us. Thanks for watching. So if you're interested in options trading, go claim your free 2-week trial on my website. In that time frame, you'll definitely see a wide variety of trade types: iron condors, strangles, calendars, earnings plays, pairs trading. I have many profitable strategies that you'll be interested in. Come join the VTS community.